Here is a baker's dozen of 13 of the highest quality blue chip dividend growth stocks on the planet. The highest quality, all those that are A-rated or better, have the highest PE ratios and the lowest earnings yields. In this video, we'll determine whether they deserve that quality premium or not. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. I've got a kind of an interesting video today. I'm going to look at a baker's dozen, 13 of the most widely recognized, highest quality dividend growth stocks on the planet, all of them in the consumer staple sector. So these are considered not only high quality, but also among some of the safest stocks you can invest in. And I'm going to go through the characteristics of them and try to give you some insights into which ones are buys, sells, or holds as I go through this portfolio. But they're all widely recognized, and of course you all know all of them. So I'm going to do them in alphabetical order, as I usually do. But I want to spend some time on the portfolio I've developed here so we can understand some of the characteristics. So I've got this in order of credit rating right now. I've got the highest credit rating to the lowest. Now, notice that these first six are all A-rated or better. And we're talking about Colgate, Procter Gamble, Coca Cola, Pepsi, Hershey, and Hormel, all widely recognized brands that everybody knows. Now, all the rest, the other seven, are also investment grade. They're all BBB or BBB minus or above. So they're also very high quality as well. But what you'll notice is the earnings yields of these seven are much closer to that earnings yield that I like, with the exception possibly of McCormick. Okay, McCormick has a very high valuation right now and a very low earnings yield. But the other six are actually looking very attractive here, and we'll do that as we go through each of these individually. Now, I also want you to look at dividend yields here, and I'm going to order them by order of highest dividends to lowest. McCormick, which is actually the most expensive, has the lowest dividend yield. Hershey, second lowest, and so on and so forth. And as we get down into these ones that have better valuations, you start to see higher dividend yields. And that's really a function, as I'll illustrate, by the valuations we'll look at. So let's go ahead and let's go through these now, one at a time, again, in alphabetical order. Let's start with Conagra. And I've got a long-term historical look here. And first thing I want you to notice is one of the characteristics that you'll see with most of these, they're actually not very fast growers. They're somewhat consistent growers. Conagra, as you can see by looking at the orange earnings line here, which is drawn at a PE ratio of 14.06. Now, I want to be very clear. Everywhere the stock price touches this orange line, it's trading at a PE ratio of 14.06. The blue line, or the normal PE, which is simply a trimmed average of how the market has valued the stock over the time frame being measured here. It's a thermostat, if you will, and it's a reference point. So that is 13.46. So I want you to notice, coming out of the recession, we had an extended period of time where Conagra Brands was trading at a very low valuation. Now, what should be obvious to the viewer here is that these would be the optimum times to be buying the stock. For example, if you were smart enough to buy it at the very bottom and hold it to its pretty close to its peak price, you'd have averaged over 11% a year on this stock, even though the company has only grown by 2.78%. Now, one of the things I want to point out to FastGraph subscribers is how you can use the calculator functionality of the tool to kind of see what's happened. Like you can see anytime the stock was above the orange line, that was a less than optimum time to buy. So had you bought, Conagra back here in July of 06, and I didn't pick the very top, I just kind of went in the middle of the upside here and held it, even when it went to fair value, you'd have only made 2.56% per year, and that includes dividends. Your capital appreciation would have been minuscule. You'd have basically broke even. But that's a testament to these stocks. Now, this is a BBB minus stock, and it has less than 40% debt. Now, notice that right now it trades at a blended PE of 10.74. It has an earnings yield of over 9% and a dividend yield of almost 5%. And if we're looking at the last several years since coming out of the Great Recession, if I go into the performance tab here, I want you to notice that the dividend income has steadily increased. I call this growth yield. People call it yield on cost. I like to think of it as the income growing. So if you'd have put $10,000 in, your income would have went from 367 to 392 to 408 to 413 and so on and so forth. So one of the advantages of investing in these stocks, especially in today's interest rate environment, the difference between this and fixed income would be that you could get an increase in your income each year, and you stand the chance to make capital appreciation. Now, growth rate is considered to stay about more of the same, but because of the discounted valuation, if this stock were to trade at only a 13.8 PE ratio, you could stand to make 16.7%. I believe that any stock, even a no-growth stock, is worth 15 times earnings, and that would give you, approaching a 20% or slightly, above or below 20% annualized rate of return over the next couple of years. So Conagra would be one example of one that has fallen in value. Growth rate is going to continue to be about more of the same. It's got a really good dividend record, low debt to capital, and a high dividend yield of 4.72%. This could be an optimum time to buy Conagra. I like to look at these things also with EBITDA. And I know Buffett calls this earnings before all the bad stuff, but what I've discovered is the correlation between price and value from using EBITDA as your measuring stick is very profound. You clearly see periods of overvaluation and periods of undervaluation when you use EBITDA, and clearly Conagra Brands is very undervalued today on that basis. Moving on to the next one in alphabetical, let's look at Colgate. Now, Colgate is AA- rated. It has the most debt of all of them. Its yield is 2.62%. But what I want you to note here is that excluding coming out of the Great Recession, I like to call it, the 08 and 09 recession, it normally traded at a 22 multiple. That's the blue line here. So what we're saying is the market normally applies a quality premium valuation to this stock. Now, it is AA rated, it is a brand name. But if you note when the stock got trading above that at higher PEs, like here I picked a 25, almost a 26 PE, even though you would have still made a little money owning the stock, your rate of return would have only been 2.3%. So the point is, you're not going to really lose money buying these blue chips generally. Even if you overpay for them, you can end up squeaking out a little return. You could lose a little bit of your principal because valuation matters, and it matters a lot. But I do just want you to notice the general trend of pricing here has been very flat. It was very strong from the bottom when it bottomed out at the Great Recession and was trading at a 15 PE ratio, which is what I think a stock growing at 5% ought to be selling at. But yet I can't deny the fact that the market applies a quality premium here. And, we call that. Now, if I go to EBITDA, like I did before, and look at EBITDA very quickly, I want you to notice that the normal price to EBITDA has been just under 13. And once again, we see periods of high valuation clearly indicated by looking at the fast graph and utilizing EBITDA as our measuring stick or our barometer or our thermostat, if you will, thermostat of value. Going on to Campbell Soup. Campbell Soup has been about a 4% grower. It currently has a very high earnings yield of 7.2%, a very attractive dividend yield of 3.54%. The orange line here is a 15 PE. Blue line is a 16 PE, which just gives you this gives you some ideas of what you can, how you can evaluate. You can see that it was trading at much higher PEs, coming into the Great Recession. Then it traded at lower PEs for the most part, coming out of the recession for a few years. Then we had this period of time where it got really high valued, and you could see how valuation would have really destroyed your rate of return. You could have bought this company and actually lost, 3% a year. You'd have turned 10,000 into 6,400, and even dividends didn't save you from losing money. Valuation matters, and it matters a lot. Campbell Soup is now becoming reasonably priced. Expectations for the future are still modest growth as usual. This could be a double-digit rate of return at a 15 PE. If we use the normal PE ratio of 16, it could even give you a little higher than that because, once again, the market does have a tendency to put a high valuation on it. But I want you to really look carefully at what we're looking at here. Even though this is mathematically correct, you can obviously see that it isn't something that you count on because there were many, many periods of time here where the stock traded at valuations that were different than what these numbers indicate. But what you clearly see here is when the stock is trading above value, below value, and at fairly value. And you can see that very clearly, again, once we use the EBITDA format. Moving on to keep this going quicker, we got General Mills here. Now this is one of the stronger growers at almost a 6% growth rate. It's forecast to grow at about 5.3 like it historically has. If we look at this from a standpoint of metrics, it has an earnings yield of 6.39. In other words, I would like to see it just a little bit cheaper than it currently is right now. I like to buy it at 15 times earnings or below. The fast graph isn't telling you where the price is going to go. It's telling you where it's been and where it's been going recently. And what we've seen is a correction in the valuation here of General Mills. So now, if you were going to buy this as a long-term hold, and it's currently trading at 15.6 times earnings, if you look at another period of time, this will be pretty close here, and held it to where it goes into fair value, you make 7 or 8% a year. These are high-quality, conservative companies. It has only 45% debt. It's BBB rated, and you can buy this now at a price that probably would be a great long-term hold with a good dividend yield that is growing every year. From, again, looking at performance, the dividend growth has been averaged about 7% a year, which is pretty consistent with what the company has generated as far as growth goes, 5.96 versus 7. So General Mills is starting to look very attractive here. Going on, Hormel. Hormel, I want you to note, was trading at somewhere between 15 and 20 times earnings historically. Coming out of the Great Recession, you could have bought it at 15 times earnings for a couple of years here. Then the valuation got extended. And once again, when you get these extended valuations, you tend to get into periods of time where you don't really make any money holding the stock. You get a decent dividend, but you don't get a really decent dividend yield. If I apply the dividend yield overlay here, when you're looking at this price here, the dividend yield was, about 1.4%. You can currently buy it at a 2.8% yield. So as valuation goes up, obviously your dividend yield goes down. If I look at this again using the EBITDA reference, you clearly see periods of very high valuation, a lot of price volatility here. Very high quality company, A-rated, has less than 30% debt. It's probably a better value today than it certainly was a couple of years ago, but I would still argue that it's not a great value here. But, giving a normal multiple to this stock, a premium multiple, you could make money. Now, that's assuming that the market will continue to apply a premium valuation to the stock. Looking at operating earnings, you can see the market has a penchant for putting a premium valuation on Hormel. But I still would consider this to be fully valued or slightly overvalued. It's not way overvalued like it was in recent years. That's the point. Hershey is one that the market constantly has traded at around 22 times earnings. It only got into the 15 and 16 PE ratio range during the Great Recession. If I use EBITDA here, you get, again, a real clear picture of how, the price has tracked around a 12 times EBITDA normally, and we could say recently it's been very high, but yet the stock has made great money here. But if it moves back into the EBITDA range, that the valuation that it would, you would still make 7 or 8%. That's because this is one of the strongest growers of the whole group here. 7% on EBITDA, almost 9% growth on operating earnings. And the point I want to make there is earnings growth can bail you out. It's still forecast to grow at 8%, and even the long-term growth rate is almost 9%. So this is one of the stronger. It is a very high-quality company, less than 50% debt, offers a 2.23% dividend yield now, an earnings yield of 4.29. But again, I want to remind you that the market tends to put a quality premium valuation. So if you're looking at forecasting and looking at the normal multiple in the 20s, this could be an attractive buy now. But I do want to emphasize that you are giving this company a premium valuation and therefore getting less than what the company is generating for you. Kellogg is another example of a company that the market does put a premium valuation on, but there are many, many times where you can buy the stock at a 15 PE or less. You can get almost a 4% dividend yield today. It's BBB rated, has less than 50% debt. And again, valuation matters. When you buy a stock at high valuations, you can go many, many years here with subpar rates of return. But if you buy that same stock, even though it's only a 4% grower, at a reasonable valuation, you can increase your return to 5 or 6%. But that's what this stock is capable of generating. But right now with a 4% yield, that gives you an optimum time to be possibly considering this stock if you're just looking for a safe investment and good dividend income. Kellogg would fit the bill. Here's Coca Cola, A+ rated. It has a little bit, 50. I'd like to see 50% or less debt, but it has 52% debt. But you can see the market always puts a premium valuation. Looking at Coca Cola from EBITDA, we can see that this is a very expensive value to pay for Coca Cola, but you could have bought it at a 19 PE ratio back in 2017. It currently trades at a slightly lower PE, and you'd have still made 7.5%. So the point is, overvaluation doesn't mean you're going to lose money. What overvaluation means is you get less than what the company is capable of generating on your behalf by overpaying for the stock. If you buy it, buy a stock when it's fully valued. So valuation matters, and it matters a lot. But when you're dealing in high quality blue chips like this, your odds of losing money, even when you pay high valuations, are relatively slim, and you could probably end up making a decent 5 or 6, 7% rate of return with good dividend growth along the way. So that's Coca-Cola. The next one we're going to look at is Kroger. Now, Kroger's been one of the faster growing ones at about 8%, 7.87% growth. It has a very high earnings yield now, a good dividend yield of 2.5, and it's only trading at 10.5 times earnings. The market normally discounts this. Grocery stores food retailers tend to be very, very low margin businesses, and I think as a consequence, the market tends to value them at low valuations. But even then, if I'm looking at this stock from a standpoint of its normal multiple, it still gives me a chance to make a 10% rate of return, including dividend income over time. So if you're going to invest in Kroger, this would be probably a really good time to be investing in it. Any time it was below this blue line, I would say would be good times to be accumulating it. And once again, we see when we look at EBITDA, we get these clear pictures of the overvaluation periods and the fairly valuation period. So Kroger looks attractive at these levels. Looking at McCormick, again, I'm going to start with EBITDA here since I'm here. You can see that it's normally traded at a low valuation. Once the valuation gets high here, it gets very difficult to make any money. Now, there's a lot of volatility. I want you to notice a lot of volatility here, but your odds of making a great deal of money when you see a stock trading at this kind of valuation is very, very slim. And you can see the pressure. The stock really has gone nowhere when we had a little bit dip in earnings here and we saw some real pressure on the stock. But it's got an earnings yield of only 3%, a dividend yield of less than 2%. I don't consider this a good time to be buying McCormick, but I do consider McCormick a blue chip. And if you can get it at an attractive valuation, even if you could pay this 20 times earnings higher multiple, I would say you might want to take a long-term position in McCormick, but I wouldn't buy it today. PepsiCo is, another one that the market has constantly put it's an A+ rated stock. Currently has a decent dividend yield of 2.86%, but a very low earnings yield. It's trading at a higher premium valuation than it normally does. Coming out of the recession, you can see you could have accumulated a stock for 4 or 5 years at a very attractive valuation. And anytime you'd have bought it here, you'd have been able to make, almost double-digit rates of return, just along the way. I mean, it was just very attractive and a very attractive time to buy it. Today, the stock is a little pricey. If we look at it from a standpoint of price to EBITDA, you can see the clear high valuation here. Once again, I don't think you would lose money buying this stock. I just don't think you would make a lot of money here. I think you'd be best served to try to buy it at a more reasonable valuation if you're interested. If you own Pepsi, Pepsi's a long-term hold, in my opinion. I wouldn't be selling it here. Procter Gamble, you can see the clear high valuation we've seen in the last several years. If I look at it from a standpoint of operating earnings, the market likes to put a premium. I call this quality premium, AA rated, 30% debt. But once again, when we get these high valuations, it becomes very difficult to make money. And I want you to notice that the stock tends to get more volatile when it's highly valued as well. That's another thing you should take into consideration. The EBITDA metric gives you a clear view of how the stock is trading at a premium valuation right now, based on, even given the fact that the market likes to put a quality premium. Going on, looking at S.J. Smucker, the jelly company, it's coming into reasonable valuation. It's got an earnings yield of 6.47, a dividend yield over 3%. If I look at it from a standpoint of price to EBITDA like I have the others, it's not quite where I'd like to buy it yet. Anytime it was below that price to EBITDA would have been good long-term buys, in my opinion. But once again, it's about a 7% grower historically. It's forecast to grow at about 6% going forward, which is, more or less the same growth. This stock could generate just very, high quality 7.54%, annualized rate of return going forward. All right, there you have it. There you have the baker's dozen, I call it, the 13 blue chips. Now, I want to make a couple of points about this. These are the kind of companies that I mentioned in the interview I did recently that I'm from Pennsylvania and I'm from the Keystone State. And the keystone is the stone in the center of an arch, and it's what holds the arch together. And when you're building a stock portfolio, especially a dividend growth stock portfolio, I think you want to think about building it maybe like you would think about, I can use the analogy like how you would do a baseball team. It's great to have some home run hitters on the team. I don't argue that. But you got to also recognize the home run hitters tend to strike out the most. What you want to have is a good foundational group of, 300 batters, those guys that get on base all the time. And that's what I would call these blue chips that we're talking, these consumer staples, things that people buy and use every day. They don't grow real fast, but they do grow. And some of them grow a little faster than others. But they offer good dividend yields. They're high quality, high rated. They tend to trade at premium valuations, some of them do, because the market gives them a quality premium. So they kind of would be your 300 batters. Now, like any other stock, I think it makes sense to try to buy them when the valuations make the most sense. And if you're patient, you'll get that time, as you see with several examples I did here. Anyway, I hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to the channel. Take a look at Fast Graphs. You can see how easily it can, help you make good long-term buy, sell, and hold decisions. Now, by the way, just to point it out, I did not get a deep dive into any of these companies. I covered too many companies. What I did here was give you the option to see if any of these consumer blue chips are stocks that you would be interested in researching further on your own behalf. As always, there's no substitute for comprehensive research and due diligence. Thanks for watching.